October 2025. Nearly $936 billion in commercial real estate loans are scheduled to mature in 2026, according to S&P Global Market Intelligence. This represents a 19% increase from the previous year's estimate. The maturity wave isn't decreasing, it's growing. Banks and borrowers spent 2024 and 2025 extending troubled loans, pushing maturities into 2026 and 2027 rather than facing refinancing at current rates. The mainstream real estate coverage focuses on office vacancy rates. San Francisco at 29%, Seattle at 27%, Austin at 28%. The discussion treats empty buildings as the primary problem, a supply-demand mismatch that will resolve as companies bring workers back to offices or as buildings convert to residential use. Here's what the routine vacancy coverage misses. The real crisis isn't empty buildings, it's the refinancing cliff. Loans originated in 2021, 2022 at 3 to 4% interest rates are maturing into a 7% market. Property values have fallen 30 to 40% in stressed office markets. Borrowers face an impossible equation. Refinance at double the interest rate on assets worth 40% less than when they borrowed. The math doesn't work, and regional banks, which hold 44% of their balance sheets in commercial real estate, compared to 13% for large banks, face concentrated exposure to losses. This isn't about whether offices are empty. This is about recognizing when the extend and pretend strategy ends and forced refinancing reveals capital gaps that borrowers cannot fill, and understanding what happens when regional banks absorb losses from an asset class representing nearly half their balance sheets. By the end, you'll understand why the CRE maturity wall matters more than vacancy headlines, how the four-stage refinancing crisis reveals where stress concentrates when extend and pretend ends, what $936 billion in 2026 maturities, 200 basis point rate shock, and 30-40% office value declines signal. Why 2008 CRE crisis, 1990s S&L failures, and 2023 regional bank collapses provide the pattern template, where today's extend and pretend indicators place the market in the refinancing crisis progression, how regional bank CRE exposure creates credit contagion beyond real estate, the 5 quiet signals showing stage 2 transitioning to stage 3 in the maturity wall timeline, why this hits your business credit and local lending before any dramatic headline announces regional bank failures. Let me show you the pattern that repeats every time. Concentrated lending exposure meets rate shock and falling collateral values. Stage 2, extend and pretend delays recognition. Interest rates rise sharply. Property valuations begin falling as cap rates expand. Borrowers approaching maturity cannot refinance at acceptable terms. Rates have doubled and loan-to-value ratios have fallen to 55-60%, requiring massive equity injections. Banks face a choice: force maturity, recognize losses, and potentially take ownership of troubled properties, or extend the loan, modify terms, and hope conditions improve. Most choose extension. The maturity calendar gets pushed out. Losses remain unrealized. Delinquencies stay low because loans don't mature. This creates the illusion of stability while the underlying problem compounds. This is where the market sits today. 2024 and 2025 saw massive extension activity, with $271 billion in 2023 maturities pushed to 2024 and beyond. Stage 3. Maturity wall forces refinancing. Extensions reach their limit. Regulators pressure banks to stop kicking the can. The volume of maturities becomes too large to extend without triggering capital concerns. Borrowers must refinance or default. 3 outcomes emerge: successful refinancing for well-positioned properties with strong cash flow and sponsorship, distressed sales where borrowers sell at losses rather than default, or outright defaults where properties return to lenders. Banks begin recognizing losses. Delinquencies rise. Credit tightens as banks reduce CRE exposure. This is 2026 to 2027, when nearly $2 trillion in loans mature and the extend and pretend strategy exhausts. Stage 4, forced sales and credit contagion. Property sales accelerate as lenders liquidate foreclosed assets and borrowers exit before default. Prices fall further as distressed sales set new comps. Regional banks with concentrated CRE exposure face capital erosion. Some fail or require mergers. Credit tightens across all categories, not just CRE. Small businesses lose access to lines of credit. Consumer lending standards increase. The CRE crisis becomes a broader credit crisis through the regional banking channel. This is the 2008 playbook and the 1990s S&L crisis pattern. Concentrated exposure plus falling values plus forced recognition or systemic stress. Where's the U.S. market today? Late stage 2 transitioning to stage 3. Extensions continue, but the 2026 maturity wall is too large to absorb through modifications alone. The forced refinancing phase approaches. The 2008 financial crisis included a significant commercial real estate component that's often overshadowed by the residential mortgage collapse. Commercial property values fell approximately 40% from peak to trough. The CMBS market froze. Property owners couldn't refinance maturing loans because buyers disappeared and banks faced capital constraints. Regional and community banks suffered disproportionately. They had concentrated exposure to local CRE markets and lacked diversification. Between 2008 and 2012, over 450 banks failed, many due to CRE exposure. A community bank with 50 to 60% of its portfolio in local commercial real estate saw all properties struggle simultaneously when the local economy entered recession. A $500 million bank with $300 million in CRE loans might face $50–75 million in losses if 20% defaulted, erasing capital entirely. The pattern was clear. Easy credit inflated values through the mid-2000s. When credit tightened, refinancing became impossible. Values fell, loans defaulted, banks took losses, credit contracted further in a reinforcing cycle. Today's CRE situation differs in key ways. Current loans are less leveraged, 60–65% LTV versus 75–80% pre-crisis. Banks maintain higher capital buffers. The CMBS market, while stressed, hasn't frozen entirely, but the underlying dynamic is identical. Loans originated in a low-rate environment are maturing into a high-rate environment with lower property values. The math doesn't work without substantial equity injection or principal paydown. The savings and loan crisis of the 1980s and early 1990s resulted from concentrated CRE lending combined with interest rate shock. S&Ls had funded long-term fixed-rate CRE loans with short-term deposits. When Paul Volcker's Federal Reserve raised rates aggressively to combat 1970s inflation, S&Ls faced a maturity mismatch crisis. They paid high rates on deposits while earning low fixed rates on long-term loans. Many S&Ls responded by increasing CRE lending at higher rates to cover their funding costs. This created concentrated exposure to commercial real estate just as the 1990 to 1991 recession hit. Property values fell. CRE loans defaulted. S&Ls lacked the capital to absorb losses. Over 1,000 institutions failed between 1986 and 1995. The government created the Resolution Trust Corporation to liquidate failed S&L assets, eventually costing taxpayers over $100 billion. The pattern is instructive. Concentrated exposure to a single asset class, interest rate shock, recession, falling collateral values, and institutional failures. The U.S. commercial real estate market today shows similar warning signs. Regional banks with heavy CRE concentration, significant rate shock from 3% to 7%, and falling office valuations. The recession hasn't materialized yet, but the other ingredients are present. In March 2023, Silicon Valley Bank collapsed after a bank run triggered by losses on its bond portfolio. 2 days later, Signature Bank failed. In May, First Republic Bank required FDIC intervention. These weren't CRE-focused institutions, but the pattern was identical to what threatens CRE-heavy regional banks. Concentrated exposure to an asset class that suffered value destruction from rate increases, insufficient capital to absorb losses, and rapid deposit flight once concerns emerged. Silicon Valley Bank concentrated its deposits among tech startups and venture capital firms, a single industry cluster. When tech valuations fell and VC funding dried up, deposits fled. The bank had invested those deposits in long-duration bonds that lost value as rates rose. The mismatch between asset values and deposit liabilities became untenable. Regional banks with heavy CRE exposure face an analogous risk. If CRE loans begin defaulting and regulators require loss recognition, capital ratios will fall. Depositors and markets will scrutinize banks with high CRE concentration. In an environment where deposits can flee electronically within hours, even solvent banks can face liquidity crises if depositors lose confidence. The 2023 failures demonstrated that bank runs don't require insolvency, they require fear. According to S&P Global Market Intelligence, $936 billion in commercial real estate loans will mature in 2026. This follows nearly $1 trillion in 2025 maturities. The peak arrives in 2027 with $1.26 trillion. This isn't a one-year problem. It's a multi-year wave. The composition matters. Office properties comprise approximately 14% of maturities through 2026, but office has seen the steepest value declines, 40% in major markets. Multifamily represents a larger share and has held value better, but faces its own pressures from slower rent growth and higher operating costs. Retail, industrial, and other property types show mixed performance. The critical issue is the rate shock. Commercial real estate loans originated in 2022 carried interest rates averaging 3 to 4%. Current refinancing rates are 6.2 to 7%, nearly double. For a borrower with $100 million in debt at 3.5%, annual interest is $3.5 million. Refinancing at 7% means $7 million in annual interest, a $3.5 million increase. If the property generates $10 million in net operating income, debt service just doubled from 35% to 70% of cash flow. This doesn't account for the value decline. A property worth $150 million in 2021 might be worth $105 million today after a 30% decline. The original 67% loan to value is now 95%. Lenders won't refinance at 95% LTV in today's market. They'll offer 60% LTV, meaning a $63 million loan. The borrower must pay down $37 million in principal or inject $37 million in new equity. Most borrowers cannot. Regional and community banks hold 44% of their assets in commercial real estate loans, compared to just 13% for large banks. More than 900 banks carry CRE exposure exceeding 300% of their capital. This concentration creates vulnerability. If CRE loans begin defaulting, these banks will absorb losses relative to capital that could impair solvency. A bank with $1 billion in capital and $3 billion in CRE loans faces material risk if even 10% of those loans experience 30% loss severity. That's $90 million in losses against $1 billion in capital, a 9% hit. If multiple banks face similar losses simultaneously, the regional banking sector could experience the kind of stress seen in 2023 with SVB, Signature, and First Republic. The concentration varies by institution and geography. Banks lending primarily to industrial, medical office, and grocery-anchored retail face different risk than those concentrated in downtown office towers. But many regional banks increased CRE lending aggressively during 2015-2021 when competition for loans was intense and underwriting standards gradually loosened. The Federal Reserve estimates that significant CRE stress could lead to around $80 billion in losses for the banking industry. While this alone wouldn't trigger a systemic crisis, it would create solvency issues among smaller institutions, exactly the pattern seen in 2008-2012 when over 450 banks failed. The risk isn't distributed evenly. Hundreds of smaller community banks with concentrated local exposure and limited capital cushions face genuine risk if their markets experience severe distress. Through 2024 and 2025, lenders and borrowers employed extend and pretend strategies, modifying or extending loans to delay maturities and avoid immediate defaults. Of the $700 billion that matured in 2023, approximately $271 billion was extended into 2024 and beyond. This provided short-term relief, but simply pushed the problem forward. Extensions work if conditions improve, if interest rates fall significantly, property values recover, or cash flows strengthen. But if conditions don't improve, extensions merely delay inevitable losses. A typical modification extends maturity by 12-24 months, increases the interest rate 50 or 100 basis points, and requires partial principal paydown. The borrower gains time. The lender avoids recognizing a loss. But extensions have limits. Regulators scrutinize repeated modifications as potential attempts to hide losses. After one or two extensions, regulators pressure lenders to either refinance at market terms or recognize the loss. More fundamentally, if a property generated $10 million in cash flow in 2022 and now generates $7 million due to vacancy, extending the loan doesn't restore the missing $3 million. Extension merely delays the inevitable. Delinquency data currently appears benign. Bank-held CRE loan delinquencies are 1.27%, CMBS delinquencies are 6.59%, and bank charge-offs hover at 0.3%. But these metrics mislead during extend and pretend. Extended loans don't show as delinquent even if the borrower cannot refinance at maturity. The true stress appears when extensions exhaust and refinancing is forced. This creates a data lag. The market looks healthy while stress builds. Then delinquencies spike suddenly when the extend and pretend phase ends. Distressed asset sales provide a clearer signal. In Q1 2025, distressed CRE sales reached $116 billion, up 31% year over year. This includes foreclosures, short sales, and motivated sellers. The volume is rising, indicating that extend and pretend is reaching its limits. Office vacancy rates receive the most media attention. Nationally, the vacancy rate reached 20.1% in 2024, a 30-year high. San Francisco is at 29.3%, Austin at 27.8%, Seattle at 26.6%. These rates reflect the lasting impact of remote work. Companies have reduced their office footprints. Hybrid work arrangements are now standard in many industries. Moody's projects that U.S. office vacancy rates will reach 24% by 2026, representing nearly 1/4 of all office space sitting empty. This implies property value destruction in the range of $250 billion and revenue losses of $8 to $10 billion from vacancy and lower rents. San Francisco's 29.3% vacancy reflects tech's aggressive adoption of remote work combined with companies relocating to lower-cost markets. Seattle's 26.6% stems from tech companies reducing space requirements. Austin's 27.8% presents a different pattern. Explosive construction during 2018-2022 delivered just as remote work became permanent, creating oversupply. Contrast this with Miami's 15.6% and Charlotte's with 15.8% vacancy markets benefiting from continued growth in industries less amenable to remote work. But vacancy alone doesn't cause a crisis. Japan maintained high commercial vacancy for decades without systemic banking failures. The crisis occurs when falling occupancy combines with refinancing pressure and insufficient equity. A half-empty building might service debt at 3% interest. At 7% interest, the same cash flow cannot cover debt service. The owner defaults. The lender forecloses. The property sells at 40% below the loan balance. The lender absorbs a loss. Office to residential conversions receive attention as a potential solution. Cleveland leads with 11% of its office inventory converting. The economics work best for older buildings with narrow floor plates. Modern office towers often have deep floor plates, making residential conversion expensive or impossible. Even where feasible, costs are substantial, $200, $300 per square foot, including renovation. The conversion economics only work if the office building can be acquired at a deep enough discount. Regional banks fund the small and medium businesses that drive local economies. When these banks face losses on CRE loans, they tighten credit across all categories. Business lines of credit get reduced or eliminated. Small business loan approvals decline. Standards tighten for all borrowers, not just real estate developers. This credit contagion is the transmission mechanism from CRE stress to the broader economy. A manufacturer with healthy operations might see their bank line of credit reduced because the bank is managing CRE exposure and capital constraints. A retailer with no real estate holdings might face tighter lending because their community bank absorbed CRE losses. The 2008 crisis demonstrated this dynamic. Small business lending fell sharply, not because small businesses were failing, but because regional banks faced capital constraints from CRE and other losses. Credit availability matters more than credit cost for many businesses. A company can adjust to higher interest rates. It cannot operate without access to working capital. Consider a regional bank with $10 billion in assets and $4 billion in CRE loans, 40% of its balance sheet. If that portfolio experiences 10% defaults with 40% loss severity, the bank faces $160 million in losses. Against $1 billion in capital, that's a 16% reduction. Regulators require certain capital ratios. When capital falls, the bank must reduce risk-weighted assets. The fastest way is to stop making new loans and reduce existing credit lines. So the bank notifies its business clients that revolving credit lines are being reduced by 20%. A manufacturer with a $5 million line suddenly has $4 million. These businesses didn't deteriorate, but the bank's CRE losses forced the credit contraction. The businesses adjust by reducing inventory, delaying expansion, or laying off workers. The local economy slows, tax revenues fall, more commercial tenants struggle, office vacancy increases, the cycle reinforces. This is why CRE stress matters beyond real estate. The concentrated exposure in regional banks creates a transmission channel to Main Street. Here are 5 signals to watch through 2026-2027. Signal number 1, CMBS delinquencies exceeding 10%. Currently at 6.59%, this metric leads bank-held loans because CMBS loans typically have stricter terms and less flexibility for extensions. When CMBS delinquencies breach 10%, it signals that extend and pretend is failing broadly. Signal number 2, regional bank CRE loan sales accelerating. The $2.8 billion multifamily loan sale from a large regional bank to Bank of America in 2024 was the largest non-FDIC-assisted CRE loan sale in history. If more banks begin selling CRE portfolios at discounts, it indicates capital pressure and marks to market forcing recognition. Signal number 3, office to residential conversion pace. Cleveland has 11% of its office inventory converting to residential. If this pace spreads to other major cities, it indicates owners recognizing that office use is permanently impaired and alternative uses provide better economics, even with expensive retrofits. Signal number 4, small bank merger activity increasing. When regional banks with CRE concentration face capital pressure, they often seek mergers with larger institutions. A wave of small bank mergers would signal stress similar to the post-2008 consolidation. Signal number 5, Fed stress test results showing material CRE losses. The Fed's estimate of $80 billion in potential losses under severe stress scenarios provides a benchmark. If actual losses approach or exceed this figure, systemic concerns will emerge. Next episode, the consumer debt bomb, how $1.6 trillion in credit card debt, rising delinquencies reaching 2009 levels, and student loan payment restart create the household-level financial stress that compounds the commercial real estate crisis. The pattern is documented. The sequence is clear. The only question is whether you recognize the refinancing cliff before forced sales, bank losses, and a credit contagion make recognition unavoidable through loss of business credit access. This isn't about predicting the future. This is about recognizing when commercial real estate debt operates outside sustainable refinancing parameters and understanding what historically happens when concentrated bank exposure meets rate shock and falling collateral values. The extend and pretend phase delays recognition. It doesn't prevent it.